why should people look at real estate as a really good investment asset class?
In India today, we are at a point where outside of equity markets, there had been very little options.
So, I think you touched on a very interesting point, financialization, because that's not what real estate used to be like, right?
That's
For
right.
the longest time, it was a bit, gundas and cash, and there's always, every movie had some bad builder who's doing something.
So you're right. I mean, most movies have a bad builder, but I think it has evolved a lot. So when Real Estate Regulation Act came, I mean, they put in a lot of restrictions. The two very prevalent methods of making money in real estate were.
Where do we see the Indian real estate market going?
So I'll just quote something that we very recently expectation based on that some of the statements coming out of NatCom is that by close to 2047, 2050 and all that, we got to be a 10 trillion sector.
Hey guys, welcome to the 8th episode of our podcast. We're here with Mr. Ashish Khandelia, a veteran real estate investor with over 20 years of experience in the real estate market in India. He's founded Certus Capital 6 years ago, and till date, they've advised on 8,000 crores worth of real estate transactions, and they currently manage more than 500 crores worth of real estate assets. So thank you so much for joining us on the podcast. We really appreciate you, giving up your time to share your knowledge and lessons with us. Would love to know about, why should people look at real estate as a really good investment asset class?
See, I think in India, real estate has always been a big part of personal portfolios. I think a lot of Indian households have more than 50% in physical assets, which is largely real estate, right? I think to date, a lot of that real estate has been held just because your primary home itself becomes a large investment. I'm talking about, population at large as opposed to just the HNI kind of a population. But I think to be very honest, in India today, we are at a point where outside of equity markets, there had been very little options, from a financial investing point of view, right? Real estate is actually evolving to a point where it can give you decent returns, mid-teen kind of returns if done well. And now you can do it in a financialized manner, which is as easier as doing any other financial asset like equities or otherwise. So I think increasingly that financialization will drive more participation. This is what happened to equities when mutual funds came on the scene, and over the last 30 years of their existence, the market has evolved to such a large market. I think that's expected to happen to other asset classes, including real estate.
So, I think you touched on a really interesting point, financialization, because that's not what real estate used to be like, right?
That's
For the
right.
longest time, it was a bit, gundas and cash, and there's always, every movie had some bad builder who's doing something. So,
That's
what's
right.
what's happened with the real estate industry? How has
Yeah.
it gone from that to where we are today, where we have major
Yeah.
listed players like Godrej and Oberoi and
Yeah.
large transactions? I mean, you've been in the market for so long, so
Yeah.
what's happened here?
No, I think it's like so you're right. I mean, most movies have a bad builder, but I think it has evolved a lot. Uh, I think the thing is, it's just the journey of various different industries. Real estate now had been on that kind of a journey for 20 plus years. So incidentally, I was kind of lucky enough when it was starting to institutionalize in early 2000s. So to be very honest, even we don't know before 2000, right? And at that point in time, a lot of it was highly fragmented, small players, small places, too much cash involved, no regulation at all whatsoever, and all that, and very limited institutional participation. In Indian real estate, in fact, the regulation has come only for the last 5 7 years. But since the institutional participation started in like early 2000s, the institutional participation itself forces people to actually become streamlined, because institutions have their own requirement in terms of transparency, governance, controls, and all of that stuff. So that has been going on for 20 years. And now for the last 7 8 years, there has been a massive regulatory push also. I think if you go back to the early 2000s, most players, barring a very limited few, were smaller. And even those limited few who were larger also were not as organized. I mean, the 2003 4 is when institutionally capital started looking at it. I kind of remember I used to be at Kotak and all that, and there were no foreign investors present in India. Incidentally, between 2004 to 2007, massive amount of that capital came in. Kind of also was global liquidity was very high just pre GFC, And 2005 is when the foreign investment regulations for India were opened up in Feb 2005 by Press Note 2. So after that, the initial experience, honestly, of the investor wasn't great because there was very limited talent, very limited history of looking back and how Indian real estate should be underwritten, evaluated, etc., etc. But it became the start, and and I mean 2007 was one of the largest years for Indian real estate from an IPO point of view. Indian real estate in 2007 has more than 40% market share. Wow. 9,000 crore of an IPO in 2007 was a big number. Yeah. And which is what DLF did. And there were several thousand crore IPOs. Some of those players were actually not great. I mean, DLF is great. I mean, they are very big. But many of those players who did actually thousand crores IPO at that point in time are either non-existent or kind of not there. So, so I'm just giving you the context of that time. Anybody and everybody was attracting money.
But you've picked a very interesting point in history. You've talked about 2007, yeah, as being a monumental year for real estate in India, as opposed to a monumental year for real estate globally, because right after what happened was the 2008 financial crisis, right, and a lot of it was triggered by American real estate, or that's right, financialization of American real
That's
estate.
right. That's
So how did that affect India? Well, I mean, what happened in 08, 09, 010 after the big blowout of 07?
So to be very honest, India, not much happened. Thankfully, because India was actually pretty much still very domestic in that sense. While a lot of this equity money came into real estate, it wasn't monumental in the context of the overall Indian real estate size, right? And the fundamental issue that happened in the US, that was a lot more driven by the entire banking sector and the financial sector getting caught up in all these subprime loans. Mm-hmm. But in India, what happened was there was a blip because there was a global blip and a lot of money went back.
Yeah, I think so the equity markets around like 50% or
equity
so.
markets, because equity markets that time was totally driven by FII money, and all the FII money got pulled back. So equity markets dropped precipitously. I mean, they went back from 22,000 back to down to some 8,000. But then I think the India saw a very steep recovery also, right? Both in equity markets, even real estate markets dipped by 25-30%. But by the end of 2019, they were back up.
Right.
And from 2009 onwards, in fact, what happened was the excesses of 2006 and 7, both in private market and public market, were removed because a lot of this hot money that came, most of this money came from global financial investors, both in the public markets and in the private, and that was gone.
Right.
So there was more semblance of right kind of capital, more thoughtful capital, and then just the sector though, because of what all these happens, a lot more professionals have actually entered the space and started professionalizing quickly, right?
Okay.
Some of the people who were doing a good job of whatever money they have raised, like Oberoi Realty. I mean, yeah, I would say 2007, I was in Morgan Stanley. We did a 675 crore investment in Oberoi Reality. And it was already on a very good path, and they used that very well to kind of continue to grow from strength to strength. And then they went to IPO in 2010. And I mean, that time, I think, I don't remember now exactly, 8, 9, 10,000 crore IPO. Today, they're like a 70,000 crore plus company. So, yeah, kind of that's the journey of real estate by one example per se. So, yeah, so I think then 2010-11 is when the sector slowly and slowly has started to become more institutionalized.
Right. So I think earlier you spoke about the impact of regulation as well, right? And
Right.
that was something you cited as a really major
Right.
theme of the
Right.
last decade or so. Um, could you explain a little bit more about
Right.
that to somebody that's not in the industry?
Right.
What is the major regulation in play, and what has it done?
Right. So, see, I think the point that really was that uh, for the longest of time, till I think 2017, if I'm correct, 16 or 17, when Real Estate Regulation Act came into play, there wasn't really any regulatory framework or any kind of a code which governed the behavior of real estate players. Now you think about it this way, like if you are giving even 5,000 rupee to a mutual fund, it is a highly regulated industry.
Yeah.
On the other hand, you are giving your life saving to buy a home, and that home is not existing today. The guy may not have even bought the land, and he had the ability to take a lot of money from you. And that was really the reason why there was such a bad name for the industry. So when Real Estate Regulation Act came, I mean, they put in a lot of restrictions. What can be done, what can't be done. Now today, you cannot actually go and sell a project unless it has all the approvals in place, right?
Okay.
Then once you have actually started selling and you start giving money to the developer, it also needs to go into certain escrow control accounts, and you can only deal with that money in a certain prescribed manner, right? And that is one thing that, and then there are significant implications which are on you as a developer or promoter of that project if you were to fail,
Right.
right? So I think all of that has one forced a lot of people who actually wanted to be fly by night guys to be out of the business.
Gotcha.
And a lot of other players also who want to be in this business, they know this obligation exists on them. So they have sobered up and, kind of better now.
So let's talk about what's driving returns in real estate. And I'd actually like to maybe to simplify it for our viewers,
Right.
try and take a unit economics type of example. So
Right.
let's say I'm a developer. Okay, I've got maybe some cash. Maybe I've bought a plot of land, and my intention is to build, let's say, a residential building and sell that.
Yeah.
Where would somebody like Certus Capital come in? Where do the returns get made? How do the returns, like, if you could just give us a bit of an example,
Yeah.
so that
Yeah.
how does real estate make money?
Yeah.
Very simply put.
Yeah. So see, I think so. Two parts to the business, right? One is how people who are producing real estate makes money, and then how you as an investor into this asset class can make money, right? Of course, and these two are very different. I mean, the guy who is actually doing the business of development, he has a very different risk and a very different kind of a return that he's trying to look at. You as an investor can make several different choices, especially today, right? So I think purely from a developer's point of view, I think it's like any other industry, and it has its own cycles. There are points in time when it is very profitable, and there are points in time when it is not so profitable. So there, I think the thought process is very simple. I mean, like any other industry, you have a few raw material. In the case of real estate, it's really land, and then you put the building together. You kind of try and make a return on it. Government is a big participant in this thing by paying various licenses, fees, stamp duty, GST, and income tax. So that is a significant component of the overall thing. In general, in various different cities, I mean, the margins will range anywhere between 15 to 25% on your revenue, right? So, and to that extent, now it is becoming as much like a manufacturing model, especially if you go to cities like Bangalore, Pune, and all of that stuff, right? Both from a consumer psyche point of view, they want strong brand, they want strong performance, they want on time delivery, high quality, warranties, everything like what you would expect in anything else. And similarly for players, the sizes are becoming very, very large. Earlier, like a 1 lakh square feet project was considered like a big project, right? Today you are really talking about projects in millions of square feet, right? So that's kind of their business in that sense, and it goes through its own cycle. I mean, in the market where, let's say, for example, 2009 to 2013, things are running up. So actually land prices are going up, and then you are adding land as your raw material, and then suddenly from 2014 to 2020 markets are flat. So as a developer, you are actually not making any great money out there, right? On the other hand, that time commercial markets were doing well. So different. I mean, it's different a topic in itself. Yeah. But let's talk more about what is more relevant to most people as to how do you as an individual can make money out of real estate, right? So see, historically, two, three different components of individual investors have tried to play it differently, right? If you go back again, I'm starting back like in the early 2000 and all that. The two very prevalent methods of making money in real estate were for HNIs, giving unsecured, very unstructured loan to developers, right? And this was more of an HNI business. And for individuals, a lot of pre-sales. So what RERA stopped actually was actually also a way of making money for people, right? Because the guy has no land, he's buying land, he will actually do a pre-sale. There are no approvals, there is nothing. But then he'll say, okay, here is the thing. This thing sells at 5,000 rupees. I will give you 25% discount, 3,500 rupees, 3,700 rupees is your unit. And a lot of this pre-sale business used to go on. Now people with good brand, actually did a good job of it. That was the way to financing. So those were the things. And that time, I think it was okay for doing so in residential real estate, especially where it used to happen, because you were making a lot of money in a way on the buy. You were taking a lot of risk. And if that guy were to not deliver, you had very little protections because there was no law or anything protecting you in a meaningful way. But that was the way to make money. But today, I think the landscape has completely changed. Today, there are various different. So now, if I were to just juxtapose the way uh, the way you make money is because there is a certain need for that capital. That need for that capital is with that developer. Earlier, he was financing that need by doing this pre-sale in a very unstructured manner. Today, a, a compliant developer cannot go and launch his projects and do these pre-sales without having all those approvals in place. So he still need to buy the land. He still need to cook the project. Approvals take time. There is a cycle of anywhere between 6 to 18 months to get there. And when you launch, and if you have a decent brand, you are actually not leaving that much money for a typical investor on the table, right?
Right.
So, but then that is where people like us come in. So now there is a complete, India as a market now need almost 1 lakh crore per annum in terms of construction or project related funding. Right. So that money needs to be provided by someone. People like us are doing that business. And when we provide that kind of money, that is where you can actually make a good 14-15% return. And now it's very systematic. It's secured. Projects have regulatory approvals in place. You actually have proper mortgages, corporate guarantees, personal guarantees, escrow controls, all of that. So I think now there are opportunities where you can do it in an extremely systematic manner. Again, it is also going through an evolution. So, for example, for about 5 odd years before starting Certus Capital, I used to run KKR's real estate lending business. KKR is a large global institution doing alternative investing. But even while running that business, there was no opportunity for me to participate in an opportunity like that. And those opportunities, by and large, were producing 15, 16% fixed returns.
So what's the lot size of an opportunity like this, right? Let's say a developer needs to go out and raise. I think you mentioned the total figure is 1 lakh crores.
Yeah.
In a year,
Approximately, yeah.
approximately. Let's say developers raising 500 crores for
Yeah.
a 3 tower block
Yeah.
somewhere. Do they go to a single lender and say, give me 500 crores and I'll pay you 15%? How does the deal actually work? I mean, do they issue bonds or like?
Yeah. So by and large, this market has been divided into two places till now. Either there are lending institutions, which can be banks, which can be NBFCs, and then there are alternative investment funds. I think these have been the three primary sources, and of course, there's foreign capital, right? So all of these are the constituents of capital providers in that sense. Banks can operate a certain segment of it, pure construction finance at a certain level, and also real estate even today after all the consolidation is still 70-75% still localized. So banks are able to service a certain kind of developers, but not a very large. NBFCs fill in some of the gap. Then alternative investment firms have very different risk appetite and a higher return, but available only to mostly HNI investors because the minimum ticket size is at least a crore, right? What is happening, and people like us are doing that. We, in fact, decided 2.5 years ago to create a platform called Earnest.me. What we were doing with that is all this institutional knowledge that we have, that we work with the institutions, we kind of productize that in the form of bonds. We said exactly this business that I would sit in KKR and do, and the way we will manage it in terms of diligence agencies, monitoring, post monitoring controls. We will do all of that. But we will also create a very simple, transparent channel for someone to participate in that. So now, with a minimum ticket size of 10 lakhs, ours is one such platform, and there are more coming, right? Because as the industry is growing, so in a way, it is akin to the development of debt capital markets. Like if you talk about RBI and SEBI and all that, for the longest of time, there is a massive desire and interest in creating India's debt capital market, but it hasn't really happened. 98% of that is triple A, double A, but that's not the case in Western countries.
Yeah.
Right. So if you think of the evolution of any of such asset class, right, like you think of mutual funds, before that, they were market makers for individual stocks.
Yeah.
There will be, okay, if you want to invest into this is the guy, he knows, he buys, he sells, he's the market maker. Similarly, and now after 30 years, it's like a well-oiled machine,
Yeah.
right? But similarly on real estate, so we are kind of wanting to be playing the role of an alternative debt capital market creator. And within that, since our expertise is real estate, we have chosen that as a starting point,
Gotcha.
right? And now what we are doing is exactly your point, 500 crores somebody wants. Okay, 500 crores is one size. The sizes range anywhere between 50 crores to maybe 5,000 crores, right? So what different players, based on their own sizes and their availability of capital, can be the single lender onto these projects. So to give you an example, when Oberoi Reality wanted 1,500 odd crores to buy land from a Tata company, they went to mutual funds. Given the balance sheet strength, they were able to place their bonds. Not every developer can do that. So we are trying to create that roadmap for players who are not at that level, but they are still very good, decent, do enough business, and we can kind of be those bond providers.
Gotcha.
And then basically create a following of people who can invest in that.
So, okay, let me put myself in the shoes of somebody that's
Yeah.
interested in investing in this thing, right?
Yes.
Couple of questions I'd have, right? So, okay, you've got a developer, they've got permissions, whatever,
Yeah.
they're ready to start a project. Let's say, it's 10,000 square, 100,000 square feet.
Yeah.
What they need to sell. Let's call it, 500 crore project. How much should they raise in finance, and how much of their own capital they're putting in? I'm just trying to
Yeah.
understand what's the leverage that's being taken over here.
See, so I think so. The thing is that typically, I mean, the way we look at it is generally speaking, when you look at a project in pure technical terms, you are really looking at not going beyond 60-65% LTVs, and loan to value of the project. Now, in real estate, many times what does happen is sometimes people have got that land really long, long back. It has appreciated. So the book value may be lower, but the market value today is much higher. When we do business, we are looking at two key things. One, we are really looking at what is the LTV today. If it is a recently purchased land, what is the LTC, which is loan to cost? But we are also always looking at the alignment. So if you are going to do this business, I mean, are you going to make a lot of money after I, as a lender, am out? And even as a lender, can I make at least good 15-16% fixed return, right? And then you, as a developer, should still be making a lot of money. So then we are aligned in that. That is the basic lending tenant in any business, not only in this business, right? More so here because it's a very cash flow based game. So that's kind of what we are looking at. So as a general rule, when we are doing these kind of simplistic senior secured credit, which to an investor should net anywhere between 14-15% with regular servicing, we are really looking at a coverage of anywhere between two to three times.
Right.
In terms of cash flows. And in terms of LTV, that is somewhere between 60.
So if that project is, let's say the land is worth 50 crores, the
Yeah.
project is worth 500 crores, the total sale, like once constructed, sold,
Yeah.
it'll net 500 crores.
Yeah.
You would loan maybe 350 crores or so to the
Probably
developer.
less. Because 500 crores is the top line.
Right.
The bottom line is probably maybe 200 crores or 150 crores out of that. In that sense,
Right.
that's the surplus it'll create. And also, what happens is because of the way the residential works in India, we will sell it along the way. So we want to make sure that we are really reasonably well covered, almost 40% covered on the cost that he needs to spend. And the balance 50 to 60% generally we have seen comes through the sales as you go along. But there's a lot of work that goes onto his brand, onto the market, onto the sellability, onto the pace of it, and all that.
So on that 500 crore project, 500 crore top line, you loan maybe.
So let's say, for example, on that 500 crore top line, if the cost was total 350 crores, right? 150 is the profit he's making. So out of that 350, generally speaking, and most people try to work with lower working capital, which we don't honestly advocate, but generally speaking, a overall financing requirement of about 150 crores to 175 crores is more than enough.
Understood. So, what are the big risks to this investment? And I mean, from my point of view, there's at least two that I can think of, right? First is, let's say something happens, project is delayed by 1 year, 2 years. Now, all of a sudden, your interest costs rack up.
Right.
Things, never happen. Second source of delays, if second risk factor is if the project never gets built for whatever
Right.
reason, there's
Right.
some legal entanglement which happens often.
Yeah.
And a project never gets built. What happens in these cases?
So there are two things there, to be honest. I think so. Let me address the second issue first because it's a larger issue. It's a binary issue. The first one is about timing.
Yeah.
The second one is about it seeing the light of the day. And if it doesn't see the light of the day, of course, everybody's capital is at risk, right? So a very, very good question in that sense. And this has been a big issue for real estate projects in the past. Now, two, three things have changed in this. One, I think as the sector has come of age. So earlier, a lot of projects would get stuck. Why? Two, three reasons. Point number one, the guy who's operating them is very unstructured. He has actually launched the project, started taking money, started taking investments, blah, blah, blah. When a lot of things about that project were just not in place. Okay, you have taken a land which has a reservation to be built as a hospital. Now, if you kind of try to position it, I will do a residential project here, there was no regulation preventing you, and there was no regulation saying you can't do it today. All of that has changed. So now, when you are actually going ahead with the project and all that, you know, there was this whole RERA mechanism which will ensure that when can you launch it. We as investors, that whole thing has changed. Now, 20 years back, there was no diligence agencies. So if you want to do business, you need specialized agencies which can do that. Today, there are a lot of very sophisticated agencies which we work very regularly with. So all of these things can be checked. So to be very honest, there's a code, there's a regulation. If you are operating a factory, that also needs to be operated with a certain regulation. Right. So if you're operating with that regulation, there is no reason why it won't get built. Just because of legal entanglements. Title checks, you need to do title checks. Yes, a lot of lands have title issues. So if you're not a sophisticated enough player who understand those issues and would check them, you will get into a problem. So why again real estate lending becomes sometimes bad for a lot of people is because that expertise is not there. But it just looks simple. Yeah, land is here in Nariman Point. It is gonna be so much valuable. And maybe I can do investment against that, but then you will get stuck if you have not done the process. So
So
that's one.
is it fair to say that any project that you invest in today will 100% reach completion? Forget timing, but
It has to.
It'll get done.
Absolutely. Absolutely. Right? So the point being, I mean, you should never say 100% because, yeah, there are like force majeure events and all that stuff. And tomorrow there's an earthquake and everything falls down.
Sure, you can't.
Right? I mean, suddenly things can go dramatic. But there is absolutely no reason anymore where you can figure out that there are no fundamental issues which will stop it from getting completed. Then comes the business side issues,
Right.
which is okay, everything can be built. If you had the right capital, if you had the right working capital, if you had the right product, it will do it. Now, you built a factory which is producing a product that nobody wants. Ultimately, that's going to fail. Same thing is going to happen with real estate also. If you built a product which is in the wrong market or priced wrongly, and now you want to sell a project which has a 50,000 square feet, but then it is only a 300 square feet apartment. I mean, that two things will not go well. A 300 square feet apartment in Bombay can still probably sell at 15,000 to 20,000 rupees a square feet. Right? And people have tried this and they've failed. Okay. Right. So, but yeah, if somebody is paying a 50,000 rupee a square foot price, he's probably looking at a 1,500 to 4,000 square feet apartment. Yeah. Right? So I think there are some of these basic things that you got to be at the right on the market. And then finally it comes about working capital. So it's just as simple.
I want to talk about this delays problem because
Yes.
I think one thing that a lot of people experience, right? Anytime anybody's trying to buy a property,
Yeah.
buy something that's in construction, something like that, there's always some delays, 1 2 years.
Yeah.
And surely that would not that would impact the solvency of the
Project
the
and
builder.
everything. Yeah.
It'll affect the
Yes.
repayments you get. Everything gets hurt,
Yes.
right?
Yes. Yes.
So how much of an issue is that?
So what has happened is, to be very honest, and now what we are starting to see is you are actually starting to get a little positively surprised. So exactly to your point. So when and you guys deal so much with the stock market, so you kind of know. It's really a function of predictability. So when you know certain things happens, you just factor it in. So if I know, and this is what you would see, and even if you will go and look at some of our investment thesis and all that, this is gonna come out. Okay, we will look at a project. Company has a certain business plan. We will stress test it for a year to say, okay, there is a good chance that some of these delays may happen. Then we will stress test it for another 1 year, and we say, even if that happens, we should be fine. And what we are seeing there for us, like for example, all the 2022 investments that we made when we started this new format, Earnest.me, they were all supposed to mature by 2025, but they're already all repaid.
Okay.
Because we factored in these concerns and delays, and if they were to happen, we should not get impacted.
Understood.
Right? So part of it is that predictability is improving, and there is certainly an element of real estate which goes through certain out of control issues. They are not fundamental, they just need to be factored in. So to give you an example, okay, last year we were facing huge pollution issues. When we were facing huge pollution issues, because a lot of infrastructure development was going on, so government came up with a certain regulations, rightly so, because they are focused on civic environment and just not the projects. Yeah. So they said you got to do these 10 things. This is the kind of the movement. You will not operate the site during these hours, etc. That will add probably 2-3 months to the project timeline, right? But I think now today we all understand that we need to provide for it. Not only we developers provide for it in their own business plan, they look at these variabilities and they still want to make sure that the project viability remains. Now, if you squeeze some time, you'll make a little bit more money. If you enter into that rough patch, you'll make a little bit less money as an equity provider. As a lender, I am very clear. I still need to make my same return. Understood. Right? And that needs to be factored in.
Understood. So I have a question here, right?
Yeah.
So one thing that the stock market does really well, right, is that you have instant liquidity, right? Like
Yeah.
I bought today, I can sell tomorrow. Now let's take real estate as in, like, let's talk about
Yeah.
pre-construction, or like generally
Yeah.
pre-delivery financing for real estate. Let's call it that. Um, is there any secondary market liquidity, right? Like, let's say I've worked through Honest.me or any number
Yeah.
of platforms. I've given the developer some money. Whatever, project is fine, but
Right.
I need the money.
Yeah.
Is there a secondary market? Can I exit my investment?
Yeah.
Can I cash out early?
Yes. So I think that's a function of the instrument that you're dealing with. So one example in real estate today that has become, like for example, otherwise you wanted rental income, you will go and buy a office or something, and there is no liquidity in that, or it takes time. On the other hand, when you look at REITs, it's instant liquidity.
Right.
Right? Instant liquidity come at a price. Right? In stock markets, you want instant liquidity, the market may be down 25%, you need to take that haircut, right? In REITs and all that, unlikely, because the instrument is such that you shouldn't have that much of volatility, but the overall return profile is kind of lower in that sense. And at that point in time, you may have to still leave some money on the table. In a stock market, you have to probably leave more money or no money, depending on where the market is. Here, it might be lesser. What we are doing is also going to get to the same thing. So today, in fact, when we are creating these bonds, exactly the idea was you have again fractionalized it in a certain manner. And therefore, because of that, yes, you can sell your bond, right? Are they as liquid as you would like them to be today? No, because it is still an early stage of the product or investment category developing. But absolutely. Today, if an investor of ours were to come, which we don't promise, but if somebody really needs it, I can buy it. That's where the whole idea of being a market maker being. That while the market at large is not giving you that much liquidity, but I am the market maker, so I'll buy it and I will have enough and more avenues to deal with it. But it will get more systematized. So to answer your question, few elements of real estate, specifically REITs, have gotten to that stage where it is instant liquidity. Most other aspects are not as liquid. So you've got to invest with the horizon that you want to be in. Even in stock markets, while there is instant liquidity, if you don't invest with the horizon, you won't make the return that you want to make.
Definitely, yeah.
Right?
Yeah.
I think by and large, something similar is there, but of course, not the stock market type.
So my last question on,
Yeah.
I guess, pre-delivery real estate financing,
Yeah.
is that I think for people that have been looking at this space a little
Yeah.
bit, it's got a little bit of a bad rap from
Yes.
China.
Yeah. Yeah,
Because
that's right.
because large companies like Evergrande, they took a lot of financing,
Yes.
pre-delivery of projects,
Yeah.
in whatever structure the China allows, and for the longest time they were making great money.
Yeah.
And now they've all gone bust and that money's all gone.
Yes. Yes.
So I first I'd love to understand what went wrong with China.
Yeah.
I don't really understand that. And then I'm hoping you can explain to me why that will never happen with India. But let's start with what went wrong there.
So first of all, let me qualify. I'm not a China expert, but yes, we also have seen that, and being in Morgan Stanley and KKR, which are global businesses, including with a lot of investments in China and all that, we have firsthand seen some of those growth stories, from a distance. But yes, we have been there, we have observed, we have heard our investment committee discussions and all that stuff. I think and there is a very, I will start with that. There's a very interesting article I read on Bloomberg very recently, like literally last week, which kind of said that is China facing a Japanese moment? And I think, in a nutshell, what it was trying to say is Japan has been in a deflation for almost 20 years, and now it's kind of changing. And why did that happen at a fundamental level? Because at at your peak, when you were booming, you produced so much, and you had access to capital, right? You had an economic system, especially in the context of China, which allowed you. I mean, if India, you have to make roads, it is a bit of a painful process, land acquisition, this, that. It is a democratic process. In China, it's being their regime, you can actually mandate this needs to be done. I mean, this city needs to be shifted, a new city needs to be built. It's easier to make that money to work, and when that money is working, everybody loves it. Because money is going in there, it's making return, everybody's happy. But then I think at a fundamental level, you are producing so much more than what's actually required at some level. It can happen with infrastructure, and that infrastructure, when that utilization is lower, then at some point in time it will catch up with you, and that's why the deflation will happen, because then nobody is willing to pay that price. I think my sense is, even with the property, like you took one name, and there are a few others, Country Garden, etc. People, when we used to look at those numbers in India, we do like close to 300,000 units per annum across our top 6 7 cities. There, one developer of this category does it, and there are several of them. And of course, they have much more number of cities than India has today. It has urbanized in that sense faster, but we, in that sense, have the same population, right? They are more affluent. So I think kind of what has been happening is, in my view, too much overbuilding going on, over capacity going on than the fundamental demand. And therefore, you keep hearing about these ghost towns, etc., in China, with a lot of buildings which have been built but not occupied.
Right.
So that's just a fundamental problem, because ultimately, if you produce something which is not going to get consumed at some point in time, it won't be investment worthy. And that's exactly, in my view, the cycle that is going on. India, we have the exact reverse challenge. If you talk about it, we talk about 10 crore housing requirement per annum, right? A lot of that is in the bottom of the pyramid, where we need really affordable homes, which is a problem we as a country are still not solved. I mean, with PMA and all that, they have actually made a very good practical attempt, but we still need to solve it. Pradhan Mantri Awas Yojana.
What's that? I'm unfamiliar.
So effectively, just digressing a little bit, it basically allowed interest subsidy and certain other fiscal benefits like reduced GST and all of that stuff, or reduced stamp duty on affordable housing development. So basically, it makes it a little bit easier. Biggest challenge is for you to get a home loan as a customer who does not have a great profile. So with this interest subsidy, I think your home becomes a little bit more affordable, and with some of these reduced costs because of fiscal incentives, the overall cost. So you are trying to make the home a little bit more affordable in a still a viable business way.
Understood.
In that sense. So I think, and that has been oriented towards trying to fix this housing shortage. So in general, India has a reverse problem. We need more supply than we had been typically able to produce.
Right.
Right. So I think, to that extent, what you're seeing with China is this overbuilding and overcapacity, which was funded by a lot of capital that was available, coming back to bite them. And they had been going through this bit of a process for a period of time now. And then, to the extent possible, government keeps providing strong. They just recently did, 2 days back. So they keep providing this stimulus to try and avoid that. Every government has done that. US has done that. All of
everyone does.
So that's kind of the thing there. I think that's, I would not say that can never happen to India. If India gets into that territory that people, no matter what, want to, like, if I look at that very brief period of 2006 and 7, a little bit of this craziness was going on. Too much money being given, We thought a 100-acre land parcel can be consumed in 3 years. It actually takes 20 years to consume a 100-acre land parcel in India. Right. It's changing now. But
so let's talk about
yeah,
India's demand trajectory because
yeah,
you gave us a number 300,000 units in a year.
yeah,
And you're saying China is doing 10 times that a year, which
possible.
sure, I
Yeah,
fully buy.
yeah,
I completely buy. US will be doing much more, whatever. That's not relevant to the conversation. What is India's demand trajectory from here? We're sitting here in 2024. You mentioned another figure,
yeah.
10 crore demand a year, 100 million units a year is uh, the demand per se. What is our demand and supply trajectory from here? Right? Where do we see the Indian real estate market going? Is it like give us some
So I'll just quote something that we very recently, there was this whole NatCon conference, which is a large, like more than 1,000 developers showed up for that conference and all that stuff. And I think effectively, very simply, what are the fundamental drivers of demand? There are two. One, where is our demographics? So if there is an X amount of households getting created because most of our population is young, 25, 30 years. And the second thing is urbanization. I think if we just put these two factors together, that basically means a lot of urban centers, etc., all needs to be created. So I mean the expectation based on that some of the statements coming out of NatCon is that by close to 2047, 2050 and all that, we got to be a 10 trillion sector. Today we are less than a trillion sector. So that's the kind of thing. Now, whether it is going to be 10, 6, 7, very difficult for me also to say. We haven't really done the math. But we actually did the math before we started earnest at the end of December 2020. Our conclusions were very simple in that because we had seen a lot of this advisory business and all that. Our conclusions were very simple. We had actually come to a conclusion and we did the math that we basically need $100 billion over the course of next 6, 7 to 8 years to basically finance just the tier one investable residential real estate growth over the next 6 to 7 years, right? And that can only be done by mobilizing domestic money. Because the character of the foreign money is that it has not found a efficient way to play the development game in India.
yeah.
So I think so. Those are like the short term thought process as to where we are, and the long term thought process as to where we are. Right. So yeah. So I mean, if things were to go, it is probably some 8, $10 trillion sector in about 20, 25 years from here. And in the short run, we are very, very clear. You do need this $100 billion plus.
Okay. Well, sounds like fantastic times up there for the real estate industry. Thank you so much for sharing your thoughts and wisdom with us. I really appreciate everything. Yeah. And I've really had the opportunity to learn a lot. Yeah. So thank you so much, and I'm sure our viewers will also really enjoyed that conversation.
Thank you so much for having me here. It was great talking to you on this podcast.